All right, let's continue our discussion over differential analysis. And now that we've gone through some very, very basic general information, we're going to be looking at really some kind of what if decision-making processes for each of these items. Again, we're trying to make the best decision for the short-term and long-term health of our company, financial health. So we're going to be looking at leasing or selling equipment. This is, leasing some equipment that we've bought in the past or selling it outright. Discontinuing an unprofitable segment of a business. So if we're talking about discontinuing an unprofitable segment, we're probably going to be dealing with some segments that are profitable and unprofitable. Manufacturing or purchasing a needed part in a factory setting, replacing fixed assets, selling a product or processing it further, fun, and accepting additional business at a special price, okay? Now, I can assure you that we would not be looking at these if this was all a simple matter of saying, okay, this number is bigger than this number, and so that's what we're going to pick. There'll be a little bit of, there's some things that we're going to have to consider to make the correct choice in each of these scenarios. Okay, so we're going to look at a few of these, and then we'll do a new video so that these don't get too terribly long. All right, so the first one is a decision based on leasing or selling equipment. These are going to be fixed assets that we have. It says management may lease or sell a piece of equipment that is no longer needed. Just because it's no longer needed by us does not mean that someone else won't have a use for it. Okay? And so in making this decision, differential analysis may be used. So let's see here. It says, assume on June the 22nd of the current year, this company is considering leasing or disposing of the following equipment. The equipment was originally purchased for $200,000. Accumulated depreciation is $120,000. What that means is we have already expensed via the income statement over multiple years $120,000. So that our net book value that we have left to depreciate is $80,000. So if we're going to determine gain, loss, those types of things, it's going to be based upon this $80,000. So we have two alternatives. The first is to lease the equipment, and it says that the total revenue for a 5-year lease is $160,000. And it says that the total estimated repair, insurance, and property taxes during the life of the lease is $35,000. See, we're leasing it. So, according to this example, and this, I'm not sure exactly how close this matches current lease standards, but in this particular case, we're continuing to pay property taxes on the equipment. We're paying for repairs, and we're insuring the property as well. And that's a $35,000 expense over 5 years. Alternative 2 is we're just going to sell it outright for $100,000 and pay a 6% commission. So when we look at these two choices, we have the leasing option here. We get $160,000 in revenues minus the $35,000 in costs. We would net $125,000. The sell option, we're going to have revenues of $100,000 and costs of $6,000. That's in the commissions, $94,000. And if we look at these two choices, it would appear that we have a $31,000 advantage to leasing the equipment. Now, I do want to say one thing. Because this gap here is $31,000, there's a $31,000 difference between alternative 1 and alternative 2. The leasing of the equipment is probably the best option. But I would say this, if this was a situation where, let's just say this is 125,000 and this number here, instead of being, say, 94,000, was like 118,000, something like that, 115,000, we might have to get into some time value of money considerations, because we're not getting this 125,000 up front. We are getting this 94,000 up front. So we would have to kind of consider, okay, if we were to take this 94,000 up front and invest it for 5 years and earn interest on it, how much would we have at the end of 5 years? If it was a conservative investment, would we have 125,000? Probably not. But I just want you to understand that this is not quite as cut and dry as it appears on the screen. Okay. Let's see here. What else? Okay, so we've kind of alluded to this already, but we do need to introduce this vocabulary here, this concept of sunk costs, that, even though we paid $200,000 for this, we can only consider the remaining book value of $80,000. It says sunk costs are costs that have been incurred in the past, cannot be recouped, and are not relevant to future decisions. I cannot tell you how many times I have heard in my life someone says something, well, I've got more than that in it, when they're considering selling something. Well, guess what? It doesn't matter how much you have in it. That is completely irrelevant to the decision-making process. The only thing that matters whenever you go to sell something, for example, is how much it's actually worth. So if you buy something for $10,000 and it goes down in value to $2,000, and someone offers you $2,000, the fact that you paid $10,000 for it is not relevant. The fact that it is worth $2,000 is relevant, as is the fact that you have an offer for $2,000. Okay, end of soapbox. But you do need to understand the concept of sunk costs. Otherwise, you're going to be a lousy business person. All right, discontinuing or a segment or product. All right, so it says here, a product, department, branch, etc. May be generating losses. As a result, management may consider discontinuing, that is, eliminating the segment. Okay. However, what we need to understand is what constitutes this loss. And what we need to understand is that these losses are a combination of variable cost and fixed cost. And it says that fixed costs such as depreciation, insurance, and property taxes that have been allocated as a part of total company expenses to this unprofitable segment, these cannot be eliminated. So if we look at a business that has, say, 4 operating segments, and let's just say 3 of them are profitable and 1 of them is losing money, we can actually decrease our profits potentially by eliminating the unprofitable section. So let's look at an example of how that is possible. We have this some kind of cereal company here. It looks like they have cornflakes, oats, and flakes. And if we look here, the income for flakes and oats, for cornflakes and toasted oats is $40,000 profit from operations. So we certainly don't want to get rid of those. But when we look over here at bran flakes, they're losing $11,000. Okay, losing $11,000. However, if we do some a little bit of vertical analysis, if we can call it that, we've got 2 fixed cost components. One is related to product of $20,000, and then we also have a $6,000 fixed cost component not related to product, but just regular operating expenses. We take those, add them together, that's $26,000. So the key in making this decision is which number is higher as an absolute number. The amount of fixed costs associated with the segment, or the amount of loss. So in this case, we are considering not 26,000 and negative 11. We are considering 26 and 11. And because 26 is higher than 11, what that means is that absent the fixed cost, the bran flakes are contributing to company profits. Now, if this loss was some number over 26,000, then we have a decision to make. That doesn't mean that we would necessarily automatically eliminate this segment because we might want to keep our bran flakes just so that our competitors don't make even more money off of our absence in that market. But certainly if we have $26,000 in fixed cost, and let's just say that this income or loss from operations was, say, negative 50,000, well, then it becomes an easier decision. But in this particular case, let's look at the numbers. If we continue, we have an $11,000 loss. If we discontinue this, it says we have a $26,000 loss, and that the differential impact on income is $15,000, and that's absolutely true, because I want to go back to this for a moment. We have total company income right now of $69,000. If we eliminate bran flakes, this $20,000 in product costs and $6,000 in fixed costs have to be moved over here. So instead of 80,000, we would have to subtract that 26,000 from those products, and we would have a profit of 54,000 rather than 69,000. All right, make or buy decisions. It says companies that manufacture products made up of components that are assembled into a final product, such as automobile manufacturers, must decide whether to make a part in-house or purchase it from a supplier. Now, make or buy decisions are a little bit more complex, but we're still going to use differential analysis to help us make the correct decision. So it says here, assume, this is very tricky, assume that an automobile manufacturer has been purchasing instrument panels for $240 a unit. The factory currently operates at 80% of capacity. This is extremely important information. And no major increase in production is expected in the near future. Also very, very important information. Because we cannot afford as managers to simply look only at the numbers. We do that, we're going to be right part of the time, and we're going to be wrong part of the time. And we're used to being right, so being wrong hurts a whole lot more. Says the cost per unit of manufacturing an instrument panel internally is estimated on February the 15th as follows. Direct materials, labor, variable factory overhead, fixed factory overhead, total cost per unit. So clearly we should continue to buy rather than manufacture, right? 240 is less than 280. Well, it's not quite that simple. In this particular case, we'll be better off to manufacture the part ourselves. The reason is because when we make the panels, we're going to include all of these costs, and that comes to $280. But if we decide not to make the panels, we're still going to absorb this $68 in fixed factory overhead. So making the panels costs us $280, but buying the panels is not really a cost of $240. It's a cost of $240 plus the reallocated $68 in fixed factory overhead for a total cost of $308. So making the panels ourselves actually saves us $28. I want to emphasize again, this is only possible when we consider the concept of relevant range that we studied, right? We were at 80% capacity. if we were at 90% capacity or 95% capacity, we would have to very, very much more closely consider our options. But because we're operating at only 80% capacity, which is kind of the magic number usually, and because we don't have any expansion planned in the near future, we can go ahead and we can look at these alternatives, again, considering those facts, and we can determine that alternative one is actually the better choice. All right, let's wrap this video up and then we'll get another one going.